What if I told you that the most dangerous number in the world isn't the one you're thinking of? It's not the national debt clock ticking up in New York. It's not the price of a loaf of bread. It's not even the global temperature anomaly. 480 trillion? It's $480 trillion. It's $480 trillion. A number so vast it breaks our brains. Try to visualize it. If you spent $1 million every single day, it would take you over 1.3 million years to burn through that. It's more than 5 times the value of everything produced on the entire planet last year. It's a ghost mountain of promises, obligations, and bets, a mountain sitting directly on top of our economy, our politics, our societies. And here is the terrifying mystery. This $480 trillion isn't cash. It's not even real, tangible wealth. It's something far more abstract and far more dangerous. It's the total notional value of the global derivatives market. And its very existence is the ultimate, ticking, unspoken paradox of our modern world. This financial phantom is the reason the system feels so brittle, so anxious, so weird. Why a single bank failure can send shudders through Switzerland and Silicon Valley. Why governments seem utterly paralyzed in the face of obvious crises. Why the next big one isn't just a recession, it's a potential rewiring of reality itself. The system can't survive the next shock. It's not because the shock will be so big, but because the system has made itself so unimaginably fragile. This is the story of how we built a house of cards in a hurricane zone, convinced ourselves it was a fortress, and then doubled down on the blueprint. It's a story of genius, greed, amnesia, and a single, catastrophic idea that went from a nerdy solution to a global time bomb. Stick with me. Because to understand why the ground feels so shaky, we have to go back to the last time it completely gave way. Part 1. Our story doesn't start on Wall Street. It starts in the grimy, chaotic, and brutally physical trading pits of the Chicago Mercantile Exchange in the 1970s. The global economy was in the toilet. The post-war golden age was over, wrecked by oil shocks, runaway inflation, and a phenomenon called stagflation, the nightmare combo of no growth and high prices. The bedrock certainty of the Bretton Woods system, where currencies were tied to the US dollar and gold, had been blown up by Nixon. Now, money itself was volatile. The price of everything could swing wildly. And in this chaos, we meet our first key figure, a quiet cerebral economist named Leo Melamed. Leo wasn't a Gordon Gekko type. He was a refugee, a pragmatist. He saw the problem not in ideological terms, but in mechanical ones. How do you run a business, a farm, an airline, a factory, when you have no clue what your costs will be 6 months from now because the price of currencies, or interest rates, or commodities is doing the chatch? The answer was as old as commerce itself, a hedge, bet to offset a risk. Farmers had used futures, contracts for centuries, agreeing to sell their grain at a set price later to avoid a price crash. Melamed's genius, or perhaps his original sin, was to take this simple physical idea and apply it to the most abstract things imaginable, money itself. In 1972, he launched the International Monetary Market (IMM), the world's first financial futures exchange. You could now bet on the future price of the British pound, the Swiss franc. This was the Big Bang. They had created a tool to manage the risk of price changes. But in doing so, they created a brand new, even bigger animal, speculation. Suddenly, you didn't need to own a soy field to bet on soy. You didn't need to import German cars to bet on the Deutschmark. The link between the real economy and the financial world began its slow, inexorable stretch. The first thread of the web was spun. Part 2. The 80s hit, and with it, deregulation and a new religion, the free market. Enter our next set of characters, the quants. Math PhDs and physicists, literally rocket scientists who fled defense contracting for the big bucks of Wall Street. Guys like Fisher Black, Myron Scholes, and Robert Merton, they looked at Malamed's futures and saw not just a tool, but a puzzle. A beautiful mathematical puzzle. In 1973, they published the Black-Scholes model, a formula, two price options, a type of derivative. It was a revolution. It promised to turn risk from a scary, unknowable monster into a tame, calculable number.
Oh, quickly.
A Greek letter like delta or gamma. It won them a Nobel Prize. Banks and investment houses, now freed by deregulation, went nuts. If risk could be measured, it could be sliced, diced, repackaged, and sold. The derivative was no longer just a hedge. It was a product you could sell for huge fees. This is where the story takes its first dark turn. The original idea was risk distribution, spreading the danger around so no one got wiped out. But Wall Street, being Wall Street, twisted it into risk multiplication. They created increasingly complex instruments with names straight out of a sci-fi novel. Credit default swaps, CDS. Collateralized debt obligations, CDO, synthetic CDOs. CDS, for instance, was essentially an insurance policy you could take out on someone else's loan. You didn't need to own the loan. It was like you, me, and 1,000 strangers taking out life insurance on some guy in Cleveland we'd never met. It created a perverse incentive. The more that guy failed, the more we'd make. The system became a hall of mirrors. A single mortgage in Florida could be bundled into a CDO. Bits of that CDO could be sold to a pension fund in Norway. And a bank in London could sell billions in CDS protection on that same CDO. The real asset, the house, was buried under layers of chosum, mathematical promises. The notional value of these bets exploded, completely untethered from the actual value of the stuff underneath. The doomsday machine was armed, and its clock started ticking faster. Part 3, 2008. The subprime mortgage crisis. You know the headlines? But the real story, the heart of the meltdown, wasn't just about people defaulting on their mortgages. It was about that $480 trillion monster waking up. See, the whole system was built on one arrogant assumption, that all these cleverly distributed risks were uncorrelated, that a housing slump in Nevada had nothing to do with one in Spain. But they were all connected through the same web of derivatives, and more importantly, through a handful of megabanks that stood in the middle of it all. These banks, like Lehman Brothers, Bear Stearns, and most catastrophically AIG, weren't just making bets. They were the central clearinghouses for millions of these bets. They were the counterparty to everyone. When the underlying mortgages started to tank, it triggered clauses in the derivatives called margin calls, a demand for immediate cash to cover potential losses. It was a run on the bank, but not by depositors. Silent, digital, hyperspeed run by other financial institutions. Billions in cash demands flashed across computer networks in nanoseconds. AIG, which had sold an insane amount of insurance CDS on all this toxic debt, didn't have the cash. It was functionally bankrupt overnight. Lehman wasn't saved. The entire interconnected web froze. The trust, the oxygen of finance, vanished. The $480 trillion mountain of promises was turning out to be a mountain of potential claims, and there was no money to pay them. The entire global financial system was about 72 hours from shutting down ATMs. That's not hyperbole. That was the internal Fed assessment. We were at the brink. The response would set the stage for our current, even more precarious reality. Part 4. So they bailed it out. Trillions in taxpayer money flooded the system to backstop the banks and, crucially, the derivatives market. The lesson was learned, right? We'd rein in the monster, bring the shadow banking system into the light, make it safer. Here's the twist. We did the exact opposite. Now the post-2009 reforms. Frank Bazell, 3DID, some good things. They forced more trading onto centralized clearinghouses, so we could see the bets and demanded banks hold more capital. But it was like putting a reinforced door on a house that's already floating in a flood zone. It treated the symptom disorderly collapse, not the disease, the sheer mind-boggling size and complexity of the bets. And then we gave the system the ultimate steroid shot. 0% interest rates, and quantitative easing QE. For over a decade, money was essentially free. This had a catastrophic unintended consequence. In a world of zero returns on safe bonds, where do giant investors, pension funds, insurance companies, asset managers go to make the money they need to pay their obligations? They dive headfirst into the derivatives market to enhance yield. They use complex swaps and options to squeeze out an extra 0.5% return. So, the user base for derivatives exploded from risky investment banks to include your pension fund and your life insurance company. The system became more interconnected, not less. The mountain didn't shrink. It ballooned. From about $100 trillion in notional value in 2000 to $600 trillion at its pre-2008 peak, down after the crash, and now back up to a cool $480 trillion and climbing. We reinflated the bubble, but made it more central to the functioning of the entire economy. We institutionalized fragility, became addicted to the doomsday machine. Part 5. So why can't it survive the next shock? Because the next shock isn't coming from inside the financial house of cards. It's coming from outside, and it's coming from multiple directions at once. We've built a system optimized for a single internal financial panic, but we now live in a world of multi-fracture crises. Shock 1. The end of the Great Moderation. For 40 years, the backdrop was globalization, peace dividends, and disinflation. That's over. We're entering an age of deglobalization, rearmament, and persistent inflation. This volatility is kryptonite to a derivatives market built on stable models. The Black-Scholes formulas break down when the world stops behaving like a tidy bell curve. Shock 2. The climate crunch. Climate change isn't just floods and fires. It's a massive, systemic financial shock. Insurers are pulling out of entire regions. Mortgages on coastal properties sound familiar? The derivatives market has no pricing model for the simultaneous, correlated collapse of multiple regional economies and asset classes due to climate. It's the ultimate unknown unknown. Shock 3. The sovereign debt trap. Governments spent trillions fighting the last crisis and the pandemic. Debt-to-GDP ratios are at wartime levels. The era of free money is over. Interest rates have risen. What happens when a major economy, Italy, Japan, the US itself, faces a debt crisis? The credit default swap market on sovereign debt would light up like a Christmas tree, triggering another silent run. Shock 4. The geopolitical lightning rod. A major conflict over Taiwan, or further escalation in Ukraine, could trigger instant, paralyzing sanctions. Imagine a major financial power being cut from the SWIFT system, or having its central bank assets frozen. The derivatives web assumes counterparties can always pay. What if an entire country's financial system is made a non-counterparty by decree? The legal and financial chaos would be unprecedented. Here's the killer. These shocks are not separate. They feed each other. A climate disaster disrupts supply chains, fueling inflation, forcing central banks to hike rates, which triggers a sovereign debt crisis, which fuels political instability, which increases geopolitical risk. The system is wired for a single faulty wire. We're facing a cascade of short circuits. Part 6. So where does this leave us? 3 uncomfortable, non-negotiable takeaways. Takeaway 1. The $480 trillion isn't a number. It's a measurement of trust. That number is the inverse of faith in the system. It's the total sum of all promises that I will pay you if X happens. The larger it grows relative to the real economy, the thinner that faith is stretched. We have built a civilization on a foundation of financial promises, not physical assets. When the trust goes, it all goes, and trust is evaporating. Takeaway 2. We have not fixed finance. We have socialized its risk. The lesson of 2008 wasn't don't do this. That lesson absorbed by the big players was do it bigger, but make sure you're so central that the government has to save you. The profits from this derivative casino are still private. The catastrophic losses, when they come, will be dumped on the public through bailouts, inflation, or brutal austerity. The can has been kicked so far it's in orbit, but gravity always wins. Takeaway 3. The next crisis will be a solvency crisis, not a liquidity crisis. 2008 was a liquidity crisis. Banks had assets but couldn't sell them for cash fast enough. The next one will be a solvency crisis, the realization that the assets themselves, sovereign bonds, overvalued real estate, derivatives tied to failing entities, are worth far, far less than anyone thought. 2008. Liquidity crisis, no cash next. Solvency crisis, no value. You can't fix worthless by printing more money. You just get hyperinflation. The tools from 2008 won't work this time. This isn't a prediction of doom. It's a diagnosis of extreme vulnerability. The $480 trillion crisis isn't an event on a calendar. It's a condition. Chronic illness the system now has. We've spent decades financializing everything, turning risks into tradable assets, and then leveraging those assets into oblivion. We VA outsourced our economic stability to a web of mathematical models and legal contracts that almost no one understands, all supervised by regulators who are perpetually 5 steps behind. The warning is this: the system is optimizing for its own survival, not for ours. It will demand more bailouts, more cheap money, more deregulation in the name of liquidity. It will present itself as too big to fail, too complex to understand, and therefore too terrifying to change. So what's the call to action? Not to buy gold, crypto, or a bunker, though. That's your prerogative. It's simpler and harder. First, get radically informed. Question the easy narratives. Understand that the market is no longer a place for allocating capital to productive enterprise. It's a giant reflexive engine for wealth extraction and risk manipulation. Read beyond the financial page. Second, relocalize what you can. Resilience won't come from a bailed-out megabank. It comes from community, local networks, tangible skills, and non-financial assets. The less you depend on the vast, fragile web for your basic needs, the more you can weather its convulsions. Third, demand simplicity. In finance and in governance, complexity is the enemy of transparency and accountability. Support policies that simplify, that reduce systemic leverage, that break up institutions so entangled that their failure dooms us all. It won't be easy. The entire political and financial establishment is invested in the complexity. The $480 trillion mountain is real. The shocks are coming. The only remaining question is whether we have the courage to stop adding more cards to the tower, start building something solid, something human-scaled, underneath it before the next gust of wind arrives. Because this time, they might not be able to print enough money to stop the fall.